Good afternoon, ladies and gentlemen, and welcome to this webinar, which is titled Company Cars Choosing Tax-Efficient Vehicles. It's actually slightly misleading in the sense that the webinar is going to cover a bit more than just company cars. It is very much aimed at talking about tax-efficient vehicle ownership generally, really, whether that's through a company or another type of business, whether it's a sole trader or a partnership. And also sort of looking to cover off matters for both the owner of the business and also just the company car driver. So really delving into that then, the contents that we're going to cover, the running order if you like. First of all, I'm going to talk about income tax on employer provided vehicles with some practical examples hopefully, and after that then we'll also look at the tax implications of having employer-provided fuel, i.e. fuel that's for use privately for non-business journeys, and whether actually this is worthwhile or not. Then we'll move on to considerations for the business owner. One of the key things I'm hoping to sort of draw out today is why planning ahead is a key importance really when you're considering the tax aspects of employer-provided vehicles. I'll touch on some recent changes to salary sacrifice arrangements because actually these have potentially quite significant impacts for employer-provided vehicles. We'll also talk about pool vehicles because that can be quite a tax-efficient solution. And finally then really I'm going to talk about, it should say own car rather than own care, versus private car considerations, i.e. should you take an employer-provided vehicle or not. And again, I think that's going to be different if you're just an employee or you're the owner of a business. So really, before getting into the detail of all of that, I'm just going to pose one question, just so that I have a little bit more of an understanding of who the audience are today, which is to ask, please, whether you're joining this webinar as an employer who provides, or indeed is contemplating providing vehicles to employees. That's the first answer. An employee who drives or has been offered an employer-provided vehicle, or perhaps both A and B above apply to you. Just wait a moment whilst those votes come in. Looks like we've got the majority of them now actually, and it seems to be pretty much roughly a sort of 50-50 split between A and C. So hopefully many of you then are running company car schemes, and hopefully what I'm going to go on to say will be directly relevant to you. So starting then with the income tax position for employees on their employer-provided car. Well, the first point to note, as I'm sure most of you will be aware, a taxable benefit in kind will arise on employer-provided cars where they're available for private use. And one of the important things to remember within that is that ordinary commuting to and from your permanent place of work is private use. That's not business mileage. So the basics of how the tax charge is actually calculated, the taxable benefit in kind, is based upon a car's list price plus the accessories that may be added to that vehicle, the optional extras typically. And that list price then is multiplied by a specified percentage that is currently based on a car's CO2 emissions. We'll show this with some examples in just a minute. One of the things we're going to talk a little bit about today is diesel cars and the changes that are going on there. I'm sure many of you will be aware that diesel cars have been in the press a lot recently for the sort of, although they have lower CO2 emissions, they emit certain other harmful emissions that the government is keen to sort of target and crack down on. So currently diesel cars, because they have a lower CO2 emissions, normally carry they do always carry a 3% surcharge to those percentages. So the least polluting cars currently, and that's for the current tax year, carry a benefit in kind charge at 9% of their list price. And the most polluting cars, the top whack, if you like, is based upon 37% of the list price. If, as an employer, you require your employee to make a capital payment for the use of a company car that they're going to be getting, then capital contributions can normally be deducted effectively from the list price in working out that benefit in kind. And likewise, if there's payments for private use, they can normally go some way to offsetting the benefit in kind. Reporting of company car benefits, of course, is normally done via forms P11D, that's the benefit in kind form, and that's an annual process with the forms needing to be submitted to the revenue by the 6th of July following the end of the tax year. More recently, we've seen voluntary payrolling of company car benefits available, which, as I said, is voluntary. So not most businesses won't be doing that yet, but it's something which can be done and will tie in with real-time information for payrolling. I've already flagged at the beginning that we need to be aware of these recent changes to salary sacrifice rules. I'm going to come and cover that later on, but I'm just flagging it here again. So let's start with an example. What I'm going to consider here is the Volkswagen Golf, and I'm going to compare what I consider to be three similar versions of the same car, broadly having the same specification. You'll see that I've gone for the GTI, which is primarily because I quite like sportier versions, so I didn't want to consider a lesser model. But I'm comparing that with the GTD, which is effectively the GTI but with a diesel engine in it. And then also the newer addition to this range, I guess, which is called the GTE. And this is a PHEV vehicle. For those of you in the know, that's a plug-in hybrid electric vehicle, which means that it has both a smaller petrol engine as well as an electric motor that's coupled with some battery capacity. So I guess the first point to note here really is that the list price of these cars is all fairly similar. The GTE does carry a slightly higher list price of around about £3,000 on the GTD, but broadly comparable. There are, however, big differences in the consumption, the fuel consumption figures, and these, of course, then feed into the CO2 rates for those individual cars. So the GTI, the 2-litre petrol, as you'd expect, is the least efficient, with 44.1 miles per gallon official fuel consumption figure. The diesel 61.4 miles per gallon, but the GTE claims 166.2 miles per gallon. I mean, my understanding from reading various articles and having spoken to people who own these type of cars is that the real world miles per gallon will be nowhere near that figure. Nevertheless, it is efficient for the tests, and therefore you get the low CO2 figures. So the GTI here comes in at 148 grams of CO2 per kilometre. You can see that the diesel's a bit lower than that, but the GTE is just 38 grams per kilometre. And what that means for the benefit in kind rate percentages is that the GTI, this is for the current tax year, 2017-18, the benefit in kind rate is 28% of the list price for the GTI. The GTD is 25%, and that's including the 3% diesel surcharge. And the GTE, however, is just 9%. So we can see that that's going to be a much more tax efficient vehicle for the driver of that car. And what does that mean in practice? Well, those are shown on the next slide. And basically the benefit in kind is shown there, which is 28% of the list price for the GTI, and obviously the same for the other versions. And you can see that there's a big difference in the income tax liability then for both a basic rate taxpayer and a higher rate taxpayer. So just as a reminder, the basic rate taxpayers pay tax at 20%, a higher rate taxpayer, which is broadly people with an income of around about more than sort of £45,000 currently, will pay tax at 40% on their benefit in kind. So quite clearly the difference between the GTI and the GTE there for a higher rate taxpayer, in fact for both basic and a higher rate taxpayer, is around about 3 times the income tax. I stated earlier on that one of the key considerations and one of the points I really want to draw out is why you need to look ahead when specifying company cars. I guess typically individuals will have a company car for 3, maybe 4 years, and these emission thresholds for company car tax are changing all the time. The good news is that the government do tend to pre-announce these several years ahead. So that enables you, when you're choosing what cars you want to make available to employees, to look ahead as well and say, well, actually, this is year 1, but what's year 2 and year 3 going to look like? What are the benefit in kind tax charges going to look like at that point in time? So again, I've just run that example through really for my 3 different Volkswagen Golfs. And you can see, so I've started off the table here with the same figures from the previous slide, i.e. the 2017, 2018 tax rates. I've only included the figures here for higher rate taxpayers. And then as we roll into 2018-19, you see that there's a plus 2% increase for both the diesel and the petrol car. But actually the PHEV there has quite a significant increase because it goes up by 4%. But nevertheless, of course, we're still only talking about a benefit in kind rate of 13% compared to the much higher rates for the other 2 cars. Rolling forward again into 2019-20, you can see that there's a 3% increase across the board on all of these vehicles. So in actual fact, over a 3-year period, I guess the GTE, the PHEV vehicle, sort of fares worst in the sense that the tax on the benefit in kind for a higher rate taxpayer, which started at about £1,100, has actually gone up to nearly £2,000 by year 3. The increases on the other 2 vehicles are not quite so dramatic, but nevertheless, quite clearly the PHEV vehicle still has a far lower overall tax charge. And in actual fact, if you look at the GTE versus the GTD tax saving over the full 3-year period that I'm modelling, you can see that the tax saving is £4,272 for a higher rate taxpayer, which actually, putting that into a per month figure, is basically £120 different in tax per month. So quite a significant difference there, and showing the importance of why you must look ahead when modelling these things. So that's the basics really of the actual benefit in kind on the car itself. It's also worth considering the car fuel benefit in kind. So this is an additional benefit in kind that arises on company cars, employer provided vehicles, where fuel is also provided for private use. And the fuel benefit in kind is basically calculated by reference to a fixed sum times the car benefit in kind percentage. So for 2017-18, that fixed sum is £22,600. So just using one example there from my Golf GTI, in the current year we said the car benefit in kind was at 28%. So that gives a further benefit in kind of £6,328. So the tax on that for a basic rate taxpayer is about £1,200 for the full year. And for a higher rate taxpayer, it's just over £2,500. So the question arises, is this worthwhile? And as I put there on the slide, the answer is normally no. And the reason for that really is if you actually just think about how much fuel you can buy at those tax rates, there's quite a lot of private mileage that you can do before you actually even equal the tax that you're paying. So, for example, the basic rate then on this, petrol I think is currently around about £5.50 a gallon, assuming our GTI actually did in the real world something like 35 miles per gallon. We could probably do around about 8,000 miles of private motoring just on the tax cost alone. So obviously for a higher rate taxpayer that might be double, around about sort of 16,000 miles of private motoring, before you've actually really, as an employee, got any gain in receiving that benefit in kind. Obviously, there are exceptions to that rule, where private mileage might, for example, be very high. Perhaps people have long commutes. And the other time you do see certain sort of business owners decide that they want to take that hit is really because they don't want the burden of keeping records to track their private or their business mileage. So that the necessary adjustments can be made. So the alternatives really to suffering the fuel benefit in kind then are centred really around the advisory fuel rates. So it is possible for the employer, say, to provide all of an employee's car fuel, but for the employee to then make good to the employer the private element of that by reference to the advisory fuel rates, which are basically inland revenue published rates for different types of cars having different engine sizes. The other way you can, of course, use that is the other way round, which is perhaps more common, which is where the employee will provide all their own fuel and then will make an expenses claim for their business mileage only using those advisory fuel rates. I thought it was also worth considering vans really here, and a bit. I'll go on to talk about how vans interact with company cars as well. So vans, the van benefit in kind regime is generally simpler than the employer-provided car rules. And the good news really is that if private use is insignificant, then actually no taxable benefit at all arises to the van driver who's provided with that employer-provided van. One of the slight difficulties is that insignificant is not actually defined within statute, but HMRC do give some examples of when they consider private use to be insignificant and when it's not insignificant. I mean, I guess the first point to make is actually that ordinary commuting to and from your regular place of work is actually permitted. So that's not considered, although it is private mileage, it's not considered to be private use for these purposes. So what other examples do the revenue provide of when they would consider use to be insignificant? Well, they talk about an employee who takes an old mattress or another piece of rubbish to the tip once or twice a year. That's insignificant. An employee who might regularly make a slight detour to drop a child off at school on their way to work. That again would be considered to be insignificant. But examples of what they say are not insignificant would be using the van, say, at the weekends to do the supermarket shopping, or taking the van away for a week's holiday, and just generally really using the van outside of work for social activities. So you can see there's they're not hard and fast rules that are defined here, but the important point I think to take away is if you are providing vans to employees and you have you don't want there to be a benefit in kind, is that you actually need a formal policy in place for the use of those vans by the employees. And that really means keeping a signed declaration from the employees as to how they are permitted to use the van. But also you need to actively monitor that. It's not sufficient really just to put in place the signed declarations. It does need to be monitored, and so you do need to keep a sort of record of the mileage that's being done and such. Not necessarily all the time, but there do need to be some checks and sort of balances within that. And the main reason is because the revenue are known to request and to review mileage or say if the vehicle's fitted with the tracker records during an employer compliance review. Where a van benefit in kind does arise, because private use is not restricted, then it's actually at a much lower rate than the typical sort of company car tax rates that we've talked about. So ordinarily it's a flat rate benefit in kind, and the benefit in kind is £3,150. So the tax cost there for a basic rate taxpayer at 20% is £630 per annum, or £53 per month. There are potentially lower benefit in kind rates for zero emission vehicles, zero emission commercial vehicles effectively, although these are actually being phased out by 2022-23. So they're there at the moment. I'm not sure there's that many zero emission vans that are running around the UK at this point in time. The other thing to watch out for is that there's also a fuel rate as well for vans, where the employer provides fuel for private use, and that's currently £610. But you just need to watch out that if you're trying to stay outside of the benefit in kind regime, if you inadvertently fall into it, the chances are that the fuel benefit in kind rate will also apply, because you'll probably have been providing all of the fuel for that vehicle. Reporting of the van benefit in kind again is normally via a P11D form annually. But again, there is the option to voluntarily payroll these benefits now. Where no benefit in kind arises, then there's no report that's needed. So the important question, I suppose, is when is a car not a car or a van not a van? And the basic definition here is that if a vehicle is not suitable for private use, then it's not a car. However, if it is suitable for private use, then it must be primarily designed for carrying goods or burden if it's to be treated as a commercial vehicle. And this in practice can cause quite a lot of sort of complications, and it's not always clear cut. And the classic sort of example of that is what's known as a dual cab pickup, sort of as shown in the picture there. It's got 2 rows of seats, but it's got an open or covered sort of van-like area behind it. And these types of vehicles have historically caused some confusion, because quite clearly it is suitable for private use. It's got 4 seats, you can use it as a private vehicle, but what's it primarily designed for? And in many cases, for the dual cab pickup at least, HMRC do accept that they are primarily designed for carrying goods or burden, and therefore you're into the van benefit in kind regime and not the company car tax regime. The dual cab pickup in particular, there's some fairly specific sort of guidance around those, and generally if it's got a payload of more than a tonne, then it will normally be treated as a van. It's not quite as simple as that in practice, because actually if it does have a covered sort of payload area, if that's got a sort of roof on it, then you have to take into account a sort of determined weight for that, and will have to have a payload of more than a tonne. But very often a dual cab pickup will be treated as a van for income tax purposes. And I'm sort of currently in the process of getting quotes to have some building work done at my house, and no doubt that explains why just about every builder I see turns up in one of these dual cab pickups. Just a word then about luxury 4x4s. There have been various sort of cases that have gone before the tribunals or the courts in relation to 4x4s, but actually they will normally be classed as a car. And some of these cases, for example, there's a case involving a Land Rover where it was quite heavily modified to make it more of a commercial vehicle, have still nevertheless been treated as a car. I think the important point to take away then is, again, it's about when you're specifying vehicles, choose carefully. And in relation to vehicles where you're not quite sure whether it's going to be treated as a car or a van, do take specific advice really prior to the purchase. And I would sort of go a step further and say, don't always rely on what the car salesman might tell you. Moving on now to the tax issues for the business owner, really. There's quite a range of tax issues that obviously need to be considered from the business perspective. Everything we've really talked about so far has been the tax position for the individual who's provided with that benefit. Of course, you'd be concerned about with what deductions you can get against business profits, whether that's a deduction for corporation tax purposes or for income tax purposes if you're a sole trader or a partner in a partnership, whether you can recover the VAT on the vehicle. What are the HMRC reporting obligations? We've kind of already touched on these really with talking about how benefits in kind need to be returned on forms P11D or the voluntary payrolling of certain benefits. Other tax considerations include the national insurance cost that an employer will pay, Class 1A NIC, on the value of a benefit in kind provided. So those are the basic sort of tax-related considerations, but of course there's wider considerations than that for a business. For example, the administrative burden really of running a company car scheme. Some employers will feel that it's key for attracting the staff that they want that they have one of these schemes. And for all businesses, typically financing will be an issue as well. Focusing then really on deductions that are available to a business, most of these, where vehicles are owned and they sit on the balance sheet of a car, they sit on the balance sheet of a company or a business, i.e. normally where they're owned outright or they're being acquired under a hire purchase agreement, then you need to consider capital allowances. Those vehicles will be depreciated in the business's accounts, but depreciation is not ordinarily a tax deductible expense, and the tax deduction is given by way of capital allowances. And again, for that capital allowances regime, we come back to the emissions of the vehicle. So if the emissions are below currently 130 grams of CO2 per kilometre, then the vehicle, the car, I'm talking about cars here, will go into the main pool for capital allowances purposes, which carry an 18% annual writing down allowance, which is calculated on a reducing balance basis. Above that threshold, they go into the special rate pool, where the annual allowance is only 8%. Again, that's calculated on a reducing balance basis. So you're going to be getting much slower capital allowances. It's also worth noting that that 130 gram threshold is set to be reduced from the 1st of April next year to 110 grams per kilometre. Quite a lot of the more efficient diesel cars and indeed petrol cars will now be below that 110 grams per kilometre threshold. But just be aware of that change if you're thinking about buying cars either side of that change. Where the regime differs a little bit is for ultra low emission vehicles, and that's currently cars which emit less than 75 grams of CO2 per kilometre. They actually qualify for 100% first year allowance. So that means that in year one, for tax purposes, the business can write off 100% of the cost of that vehicle. And that will be the case whether it's owned outright, i.e. you purchased it up front, or it's acquired under a hire purchase agreement. Commercial vehicles don't follow the same rules. So vans, essentially, I'm talking about here, they will go into the 18% writing down allowance pool, and they also have the possibility of being able to claim the annual investment allowance, which could mean that you can also claim 100% effectively first year allowance if you're within your annual AIA threshold for all your plant and machinery purchases. So just putting this into a little bit more context briefly, if you do specify a vehicle that is going to go, a car that's going to go into your normal main capital allowances pool with the 18% annual writing down allowance, it's still going to take 7 years to get tax relief for 75% of the cost of that vehicle. However, if you're going above the 130 grams per kilometre threshold, that's extended by a further 10 years to get 75% of the relief. And remember, these are general pools of expenditure. They're not specific pools for individual cars. So what that means is if the vehicle is disposed of, you're not automatically then going to get the rest of the relief for those vehicles. The pool carries on unless effectively the company or the business ceases to trade, and then you might get a balancing allowance for what's left in it. So these choices actually have real cash flow implications for the business. An alternative, of course, to purchasing a car outright would be to lease it, which is quite popular with many businesses. Lease costs are ordinarily deductible, but again, we see that 130 grams per kilometre threshold coming in, and basically where a car has emissions above that, there's a 15% restriction on the allowable lease costs. So in other words, 15% will just be disallowed for the purposes of calculating your business profits. I think it's likely that that threshold will also change from the 1st of April to 110 grams per kilometre. Other costs then, we've been talking about really the cost of providing the vehicle so far, but maintenance and running costs are of course ordinarily allowable for a business, and they can be written off against the business profits, and that typically applies irrespective of whether there's private use for a company. But you just need to be aware that if you are operating as a sole trader or as a partnership, then you need to actually sort of keep records really to work out private use adjustments. For example, if a business vehicle is, say, a car is used by the owner of a business 40% for the business and 60% privately, then you're only going to get 40% of the costs allowable for tax that we've been sort of talking about above. And again, record keeping requirements are quite important there. It's not to say that business owners have to keep track of all their mileage, but there does need to be an assessment made of what the business and private split is. So touching on VAT, There's many VAT matters really for the business owner of a vehicle. I'm not going to cover them all in detail here, but the main point, I guess, to take away is that if a car is purchased by the business and it's only going to be used for business use, then VAT recovery is possible. Otherwise, it isn't. Where you've got leases, 50% of the VAT can be recovered where there's private use of it, 100% if it's a business-only vehicle. These are cars, actually, sorry, that I'm talking about. VAT recovery is usually possible on commercial vehicles for a normal sort of fully VAT-registered business that's making taxable supplies. Fuel costs carry different VAT regimes. There's various schemes here. Many of you will be aware of the flat rate scheme. I'm not going to detail them all here because I haven't got time, but it's always worth looking at those rules and working out the impact of the business. Full VAT recovery is normally possible on the running and maintenance costs of cars and commercial vehicles for a business. Of course, any VAT that can't be recovered will then ordinarily be deductible for the purpose of calculating the overall profits of the business that are subject to corporation tax or income tax. Finally, then, on the considerations for the business owner, I mentioned earlier that benefits in kind carry a Class 1A national insurance cost for a business, and that's currently calculated at 13.8% on the value of most benefits in kind, which will include company cars or vans where a benefit in kind arises. So just going back to my golf examples, really, the 2017-8 figures there are showing what the employer's Class 1 national insurance cost would look like for each of those vehicles. Again, we can see the obvious benefit of having the GTE, the plug-in hybrid electric vehicle there, which is coming in at around about a third of the petrol variant. Coming then to salary sacrifice arrangements, which I've mentioned a couple of times. As I've said, there's been recent and fairly significant changes in this area that could have a sizable impact for businesses on how company cars and vans are taxed. So the other reference that you might see to these type of arrangements are optional remuneration arrangements, or OPRA. As I said, these rules actually, they're with us. They apply from April 2017, and they apply in two types of situation. This is basically where type A is where an employee is able to sacrifice current salary in favour of a benefit in kind, or type B, where they're able to forego future salary or earnings in favour of a benefit in kind. Type B, of course, is actually harder to ascertain, and I'll come back to that in just a second, but the point here is that if you fall within these rules, then the employee will be taxed on the higher of the benefit in kind they receive or the salary that they've foregone. So in theory, therefore, having a tax-efficient company car, if that's linked to a salary sacrifice arrangement, you might still pay tax as though you'd received all that salary. So when are these rules likely to apply in practice under type A and type B is actually still a little bit unclear at the moment, because HMRC's guidance is a bit light on this. For example, type B in particular is going to be harder to ascertain. If you promote an employee, say, and you offer them an increase in salary or to take a company car, is that type of arrangement going to be caught? It's a little bit grey at the moment. Clearly, if you're only offering a salary and a company car, and that's what's on the table, then you're not going to fall into these new rules and don't need to worry about them. It's just worth mentioning that even if you're taxable on the salary that's been foregone under these salary sacrifice arrangements, it's still reportable on the form P11D. You don't actually have to put it all through the ordinary payroll. It's just that it will effectively be a higher benefit in kind that gets reported. So it's likely that we'll see new forms P11D for 2017-18. Now, of course, the next bullet point on the slide shows where the government is going with the direction of travel on this. There is an exemption from these rules for cars with CO2 emissions of currently less than 75 grams per kilometre. The message is clear. If you want to get a less polluting car and still do that under a salary sacrifice type arrangement, then you can do. It's worth also noting that these rules are much more widely drawn than just applying to company vehicles. They apply to a range of benefit in kinds. For example, where computers are provided in exchange for a salary sacrifice, or phones might be provided, then you've got to consider these new rules. It's also worth just saying this is an ever-changing arena, really, in terms of what's going on. I mean, I've said that changes tend to be pre-announced, which is helpful because it does allow you to plan several years ahead. I've mentioned the fact that the capital allowances threshold is going to change to 110 grams per kilometre, but it's also worth noting that from financial year 2020-21, there's going to be further changes to what are sort of referred to as ultra low emission vehicles, and these are going to take into account their electric only range. And that will mean that actually the benefit in kinds that we've been sort of talking about on these vehicles, which currently start at around about 9%, can come down to as low as 2%. So again, that's going to be a fairly significant change in terms of how some of these more efficient cars are taxed, and the opportunity to achieve a very low benefit in kind on specifying the right vehicle. Obviously, the pledge that was made recently by the government that basically all cars, and I think actually commercial vehicles, should be zero emission vehicles by 2050 is what's dictating the direction of travel in all of this. Just a word of caution briefly about diesels. We were told in the April 2017 budget by the Chancellor that there would be a consultation on further changes to diesel vehicle tax. And that's been sort of ongoing, that process, and we're awaiting further sort of announcements in the November budget. But some of the stuff that has been talked about is that there will be effectively car tax increases and fuel duty increases being considered for diesel cars. But also, actually, it might go a lot further than this, and there could be charges within specific cities for driving a diesel that's more than 2 years old in those cities, so-called clean air zones. And actually, one report I read suggested that that could be a £10 daily toll, and that's if you've got a diesel car that's more than just 2 years old potentially. In our sort of region, Southampton is considering that. I'm not aware that sort of Reading and Oxford, etc., are contemplating it at the moment. So really a note of caution about diesels. Watch this space. Not too much more to go now. I said I'd talk about pool vehicles. Pool vehicles are exempt from the benefit in kind regime, and that applies to both cars and vans. So these are vehicles that are used in the business by a variety of different employees. But it's important to note that all of the requirements listed on the slide must be met. So they must be available to and actually used by more than one employee. They must be available to each employee by reason of their employment. So what that actually means is that, say you've got a van, you might have a mechanic who needs to go and use that van to see, to conduct roadside repairs or something, then that would be by reason of his employment that he's doing that. Whereas actually, if that van was sort of available to an office worker, then that might not be considered to be by reason of his employment, unless it was for a very specific sort of business purpose, and that was the vehicle that was available. They can't ordinarily be used by one person to the exclusion of others, and private use should be incidental. That's not saying there can't be any private use, but it should be incidental. And the vehicle should not normally be kept at or near the home of an employee overnight. Actually, when you look into the detail of that, there's a 60% sort of rule of thumb, which says that as long as it's not at employees' homes more than 60% of the time, then you might well be complying with that. But of course, that won't be being kept 60% at one employee's home, i.e., you would expect that to be over a variety of different sort of employees that might have that vehicle at home overnight. The point to take away there is really, obviously this can be very tax efficient because there's no tax liabilities for the drivers of those vehicles, but record keeping is very much key. HMR scrutiny is much more likely on these type of arrangements, and you do sometimes see companies purchasing some quite nice vehicles which they claim are pool vehicles, and it's not uncommon to see the directors driving those on a fairly regular basis outside of work. Failure to comply, I've just therefore sort of put on the end there, mean that the normal car, van and benefit in kind rules plus fuel most likely will apply. And of course, if you've treated vehicles as pool vehicles and the revenue pick this up at an employer compliance review, if you've got it wrong, they can go back several years, assess all these benefits, collect all the tax on it, charge interest and penalties, and it can be very expensive if you get it wrong. Briefly then, own car versus company car or employer provided car. I think these are very much sort of just general observations here. Obviously, if you're a business owner, a company owner, you need to assess both sides, not just the income tax position for you as an individual in having a car, but also all the costs for the business. And you can get into some reasonably sort of complex calculations to work out what is the most tax efficient route. And there aren't really any general rules that apply because there's so many different sort of factors to take into account. I mean, what you can perhaps say is that historically, luxury vehicles were often actually more tax efficient in personal ownership. Not in all cases, but in a lot of cases. But actually, I think that landscape is potentially changing with the electric vehicles and the plug-in hybrid electric vehicles because they are tax efficient on both an income tax level, but also actually for the business, that could well be changing the landscape. If you're just an individual who's being offered a company car, then you're only really concerned with what your own costs are going to be, and so you're just really comparing that with the company car tax charges versus the cost of running say an equivalent car yourself. In all these sort of calculations, you also need to perhaps take account of the authorised mileage allowance payments, which are basically the mileage rates that a business can pay to an individual who's using their own car for business purposes. And those are 45p per mile for the first 10,000 business miles in a tax year, or 25p per mile where that's exceeded. You can also pay a supplement of 5 pence per mile for each passenger that may be carried on business journeys, which is often sort of overlooked, but can add up to some reasonably significant amounts. So, all in these payments that can be made can have quite a big impact on the position as to whether you should take a company car or not. And it's also worth noting that if your employer actually doesn't pay you, say, the full 45p a mile, they may decide that they're only paying 30p a mile, then actually it is possible to claim tax relief on an extra 15 pence per mile. In summary then, before I finish, main point to take away really is to review the position over the whole of the life of a vehicle that's being purchased. Don't just look at the current tax position for the current tax year, look ahead. But as I hopefully demonstrated, careful vehicle choice can actually save thousands of pounds in tax for seemingly comparable cars, at least on paper. Fuel benefits for company cars are rarely worthwhile. Do consider the sensible use of pool vehicles where circumstances permit that. Bear in mind what I've just said about the costs of failing to operate the rules correctly, because they can be high if things are picked up during compliance reviews, and the revenue can go back a number of years. Record keeping is important in relation to whatever arrangements you choose, so do ensure that they're robust and indeed monitored. And then finally, really just as so many webinars sort of end, just a slight disclaimer to say that this webinar is of a general nature. I've not by any means covered all the specifics of certain sort of situations within this, so do take specific advice if you're contemplating any particular sort of transactions involving employer-provided vehicles. I think I've probably used up the full amount of the time allowance, So I'm not going to answer any questions now. I can see that a couple have been raised, but what I'll do is I'll pick up and respond to those individually. If you do have any queries and you want to email me, then my email address is on the final slide. Thank you very much for listening. Goodbye.